Did you know that the U.S. debt has surpassed $35 trillion, exceeding 120% of the country's gross domestic product? But what does this huge number really mean for your money and future investments? You might think it's just a number tossed around by politicians, but it's way more than that. It could change the way you save, spend, and invest. So, what exactly is the U.S. debt crisis? In simple terms, it's when the government owes more money than it can pay back. This isn't just a national problem, it has serious ripple effects around the globe. When the U.S. sneezes, the rest of the world often catches a cold, especially when it comes to finances. In this video, we'll dig deep into the causes behind this crisis, how it impacts not just the U.S., but also global markets, and what you can do to protect your investments. At its core, federal debt is the total amount of money the government owes to its creditors. This happens when the government spends more than it collects in taxes and revenue. Think of it like your monthly allowance. If you spend more than you have, you might borrow from a friend. That's essentially what the government does, but on a much bigger scale. Now, why should you care? When the government is in debt, it has to pay interest on that debt, just like you would if you borrowed money. This means less money for things that really matter, like education, infrastructure, and healthcare. And that's not just a problem for adults, it affects you too. Like if your school had to cut programs because the government couldn't fund them. This is where the implications of federal debt hit home. There are three major culprits: government spending, tax policies, and economic downturns. First up, government spending. Over the years, politicians have approved massive budgets to fund everything from defense to social programs. While some spending is necessary, it's easy for costs to spiral out of control. Picture a teenager with a credit card. If you're not careful, it can lead to a mountain of debt. Next, we have tax policies. Sometimes, the government cuts taxes to give people more money in their pockets. Sounds great, right? But if there's not enough revenue coming in, it can lead to an even bigger debt. It's like trying to buy a new phone but not having enough cash saved up. Finally, economic downturns can wreak havoc on debt levels. When the economy takes a hit, like during a recession, tax revenues drop. Fewer jobs mean fewer people paying taxes, and that leads to even more borrowing to cover the gaps. Visual aids, like graphs showing historical debt accumulation, can really help illustrate how these factors play out over time. The current U.S. debt is a $35 trillion and climbing. This graph shows that this number has shot up faster than a rocket, especially since the COVID-19 pandemic, when the government had to step in with relief packages. Those packages were necessary to help individuals and businesses survive, but they also added to the debt pile. We're at a critical juncture. Economic indicators show signs of inflation rising, which means the cost of everyday items is going up. Higher debt levels can also lead to increased interest rates, making it more expensive to borrow money. This creates a tense situation where everybody is frustrated because it's a direct hit on everyday life. So, how does all this affect the investment climate? Well, when people hear news about the rising debt, it can shake their confidence. Investors want stability, and when they see the U.S. government struggling to manage its finances, they might pull their money out of stocks or hold off on investing. This can lead to a roller coaster ride in the stock market, with prices going up and down like a yo-yo. When consumer confidence drops, spending slows down. If people are worried about the economy, they're less likely to splurge on new gadgets or that trendy clothing line. This can create a cycle where businesses earn less, leading to even more layoffs and an uncertain job market. It's a tough situation where everyone feels the pinch. Let's not forget about the real estate market. Higher debt levels and rising interest rates can significantly impact mortgage rates. When interest rates go up, it becomes more expensive to borrow money for a home. This means that first-time buyers might find it harder to afford that dream home. For homeowners, if they want to refinance their mortgage to take advantage of lower rates, they may not see as much benefit as before. This can lead to fewer transactions in the housing market, making it a tough place for real estate investors and buyers alike. Freddie Mac Primary Mortgage Market Survey and market yield on U.S. Treasury securities at 10-year constant maturity. The ripple effects of the U.S. debt crisis don't stop at the water's edge, they reach investors around the world. When the U.S. government racks up debt, it sends a strong message that raises eyebrows globally. Investors start to wonder if their money is safe in U.S. markets. Are those stocks still a good bet? As a result, many begin to shift their investments to other countries or safer assets like gold. For instance, you might see a spike in gold prices as investors flock to it for security, while U.S. stock prices may drop as a reaction to the rising debt concerns. So, what can you do to protect your hard-earned money in a time of economic uncertainty? When the economic landscape is rocky, especially with a looming U.S. debt crisis, it's essential to have a game plan to protect your investments. Let's look at some solid strategies that can help you weather the storm and even find opportunities in the chaos. First up is diversification. This is a safety net for your investment portfolio. Imagine you're at a fair and there's a dunk tank. You wouldn't want to put all your money on one ball, right? The same goes for investing. Putting all your money into one stock or sector can be risky. If that stock tanks, you're left with a big hole in your wallet. Let's say you've invested in a tech company that's been doing great, but suddenly it faces a scandal or market downturn. If that's your only investment, you could be in serious trouble. However, if you've diversified your portfolio, meaning you've spread your investments across different sectors like healthcare, energy, and real estate, you're less vulnerable. For instance, during the pandemic, while many tech stocks soared due to remote work demands, industries like travel and hospitality crashed. But those who had invested in a mix of sectors were able to cushion their losses. Diversifying can include stocks, bonds, mutual funds, and even real estate. So, make sure you've got a variety of investments in your portfolio to minimize risks. Next, let's talk about risk management techniques. Understanding your risk tolerance is crucial. This is simply how much risk you're comfortable taking. If you're young and just starting to invest, you might feel bold and willing to take risks. But if you're nearing retirement, you may want to be more conservative with your investments. One effective technique is setting stop-loss orders. This allows you to set a predetermined price at which you'll sell a stock if it starts to drop. For example, if you bought shares of a company at $50 and want to limit your losses, you could set a stop-loss order at $45. If the stock price drops to $45, your shares will automatically sell, protecting you from further losses. Another strategy is to regularly review your investments. Markets change, and sectors can rise and fall based on economic conditions. If you notice that a particular sector is declining, say brick-and-mortar retail, you may want to reassess your holdings and either sell or reduce your exposure there. Being proactive rather than reactive can save you from significant losses. Now, let's focus on finding opportunities, even when times are tough. While many sectors may struggle during a debt crisis, some can actually thrive. For example, consider essential services like healthcare. Regardless of economic conditions, people need medical care. Companies in pharmaceuticals or healthcare technology often see steady growth even during downturns. Investing in healthcare stocks can provide a buffer against market volatility. Another promising area is renewable energy. With increasing global focus on sustainability, companies that provide solar and wind energy solutions are gaining traction. For instance, companies like NextEra Energy, which invests heavily in renewable resources, have seen significant growth as countries push for greener solutions. This sector can be a solid long-term investment as the world shifts away from fossil fuels. Tech companies focused on cybersecurity and remote work solutions are also worth considering. As businesses continue to adapt to a digital-first world, those that provide security solutions for online transactions and data protection are in high demand. Companies like Crowdstrike, which specializes in cybersecurity, are well positioned for continued growth. Additionally, look for industries that provide everyday necessities like consumer staples. Companies that produce food, household goods, and personal care products often remain stable even in economic downturns. For example, Procter & Gamble and Unilever have proven strong because their products are essential, regardless of economic conditions. While the U.S. debt crisis poses serious risks to investors, there are effective strategies to mitigate those risks and even capitalize on new opportunities. Diversifying your portfolio, implementing smart risk management techniques, and seeking out sectors that can thrive despite economic challenges can help you not just survive, but thrive in uncertain times.